Okay, yeah. So if we start from Black-Scholes model, right? The famous Black-Scholes. Okay, those who are not compatible with options, right? What options are? Basically, options are kind of derivatives which are on an underlying, right? So basically, and then Black-Scholes model come, basically BSM. And what is the underlying equation for the Black-Scholes model? So before we discuss the underlying equation for Black-Scholes model, let us just understand how do we model the underlying using Black-Scholes model. So Black-Scholes model assume that underlying follows geometric Brownian motion, right? What is geometric Brownian motion? If anyone in the meeting can say.
Sorry to interrupt. Can you let people in? I think someone is waiting.
I don't think anyone requires the permission to enter into the meeting because it is automatic for everyone.
Okay, sorry. Someone messaged in the group.
Right, right. But I can don't think anyone requires the permission to enter into the meeting. Okay, I've recorded the session for them, not an issue. Yeah, okay. So we were discussing Black-Scholes model, which is to price options, right? Now, where does Black-Scholes model start from? Black-Scholes model starts from the assumption that underlying follows geometric Brownian motion. What is geometric Brownian motion? Just this equation, ds is equal to mu s dt plus sigma s dw, right? This is the underlying, so this is how underlying behaves under geometric Brownian motion. Now, for those who are not, familiar with geometric Brownian motion, let us just discuss a bit. What is dw over here?
Uh, Stochastic randomness.
Okay, kind of randomness. Okay, what is the exact term? Like dw has a specific term, right? It's Brownian motion or Wiener process, right? So this dw is kind of, you can understand, a normal distribution with a mean of 0 and a variance of dt. Okay, got it? Any doubt? And if you try to dissociate it, then it will be like root under dt into normal distribution of mean 0 and variance of 1. Okay, so kind of understand this ds equal to, so basically I think that the audience do not are not familiar with geometric Brownian motion, so let us spend some time with this concept called what is geometric Brownian motion, and then deterministic term, stochastic term and all. Okay, so ds is equal to mu s dt plus sigma s dw. Okay, where this mu is kind of drift term. Okay, and this sigma over here is kind of variance term. Okay, a kind of term that is related with variance or volatility term, anything that you can say. Now you can see that ds is nothing but change in stock price. Okay, so option will always be on underlying, right? So here we are assuming that the underlying is the stock price, underlying is a stock, so this is nothing but change in stock price. In how much time? In time dt. So according to this model, which is geometric Brownian motion for stock prices, we are assuming that the change in stock price in time dt is because of two factors. The first one is over here, which is mu s dt. So basically ds has two kind of, you can say, we can dissociate it to mu s dt, and the other one is sigma s dw. Okay, I hope no doubt so far, right? Any doubt? Now, if you want to understand, so this is change in stock price in time dt. Okay, so now try to understand it like this. Okay, so take any stock for an example. Okay, so if you are based in India, you can take example Reliance stock, right? Now, in India, companies like TCS, right, Tatas and all are considered to be a kind of safe stock, right? So for a person who is naive in market, they may always be have that for a long time period. These are the stocks that you can, invest in the long term. What does that mean? That means he try to think it like this. Okay, so for example, let us take TCS stock, which is like of most worshipped stock in India, right? So if someone says that I want to invest in long term, you will be saying, okay, you can invest in TCS. Okay, while opinion may change, opinion may differ, but I just don't want to go into ratings. I just take it as an example. Okay, so if we are saying that invest in long term in TCS, okay, you will be saying that okay, I am investing 100 rupees in TCS for 5 years. What does that mean? So for a naive person, for a person like us, it means that TCS stock has a natural tendency to go upward in the long term, right? But does it happen for a period of like let us say 10 days? Okay. So TCS is a very good stock. Everyone is so everyone agrees to that. But can I invest 100 rupees in TCS for a period of 10 days? Will it give me a positive return? Am I sure about it? No, because
No.
there is randomness in market. Because there is randomness. So while natural tendency of this stock is to go upward, that means the drift tendency is to go upward, but there is also a random tendency, but there is also a randomness in the stock. So period of, for example, 10 days may fall in that randomness category, that random category, and you may lose your money. That means whenever you talk about a stock, they will have a natural tendency, which is that if there is no news in the market or say randomness is zero, then in what direction the stock will go? That will go upward, right? Or like this. But if there is so this is this term, okay, mu SDT, which contributes to the drift, the fundamental nature of the stock, fundamental nature of the company. And this part is the shock or the perturbation, right? Or randomness, whatever you may say. Okay. Now, because of the randomness, it might happen that since its natural tendency was to go upward, it might sometimes go downward as well for a period of like say 10 days. Then it will go up like this, then like this, then this, then this, then this, right? So this is the typical behavior that it may follow, right? And that is what we are doing by modeling it like this. DS is equal to mu SDT plus sigma SDW. TW is contributing to the randomness, as I already told. So let us remove this. So DW, as I told you, is a normal distribution of a mean zero and a variance of DT. Okay. Let us take root dt outside because it is a constant term. Then you will be having normal distribution of mean zero variance of 1. Then what this term is doing essentially, if you like, if you see it is sigma s into root under dt and a normal distribution of mean zero and variance of 1. Okay. What you can do is go to any id. For example, you can go with Python. You write this code. How will you write this code? For example, let us denote it this term as uh, maybe you can write it as like, okay, let us denote this term as random term. Okay, random term will be sigma into the if there is, if you are taking the stock path, stock price is in a path, the last stock price into root under dt. Okay, so a square root dt. Just a minute. Into maybe np dot square root dt into normal distribution of mean zero and variance of 1. So this is norm dot pdf mean zero and variance of 1. Okay, so far so good. Or maybe you, so basically what does it do, right? It basically uh, just a minute, I'm writing it wrong over here. So it is like np dot random dot norm, right? If I'm not wrong. No. So what it does is this number. So no matter how many times will you execute this, you will be getting different values every time, just because of this factor, right? Because this is a random variable. Normal distribution of 0 and 1 is a random variable. So basically every time you will be executing the code, you will be getting a different number. The ID, basically the compiler is choosing from a set of numbers which follows normal distribution, right? Having a mean of 0 and a variance of 1. So every time you will be executing this code, you will be getting different numbers. Sometimes you will be getting minus, right? Minus values as well, because as you know, a normal distribution might look like this. So you may be getting any number from here to here, okay, right? Because there is mean of 0 and variance of 1. So you may be getting any number from here to here, okay, with a certain probability. And basically ID will be choosing that number, right? Because of that number, because of that randomness, so every time your ID will be choosing different number. So your TS will be random, right? And that is why a stock prices become random. So I hope you are getting. I hope you understand what is the meaning of DS is equal to mu SDT plus sigma SDW. Sigma is the volatility term. So basically that gives a weight to the randomness part. Okay, so how much randomness is there? That is the volatility term. Okay. Any doubt till now?
Is it important to know how this geometric Brownian motion is derived?
No. So it's basically not derived. So basically, as I already told, it is just two simple terms. The first term is fundamental nature of the stock, which is mu SDT. Mu is the drift, right? So basically, understand mu as something like return. Okay, so how much return do you expect from this stock? So you will be taking historical data. Okay, so let us say you are saying that this stock gives 10% return per year. Okay, that means in 1 unit time, this stock gives you 10% return, right? Now in dt time, this will, so let us denote it as sigma. In dt time, it will give sigma dt return, and you just need to multiply by s to determine what is the total return in number, right? It was in percent. So this is sigma dts. That is, sorry, not sigma. This is should be mu, right? Return factor. So I have written it over here. Same goes to the randomness term, right? So there is, so it is, its derivation is quite simple. It is based on the thought, right? The return part, natural return part, fundamental part, and the randomness part. Okay. So you must understand where this is coming from, and I hope it is clear now, because many times you might be noticing this equation, ds is equal to mu s dt plus sigma s dw, but now you should understand how this equation is coming, right? Where it is coming from, and what is its intuitive meaning.
So do we assume the change in stock price to be like a function of time and some random variable, like some randomness?
A function of time and randomness. Maybe not a function of time. Maybe you can say, okay, yeah, function of time. Yeah, obviously it is a function of time, right? Yeah, so it is a function of time and some randomness, of course.
Okay, thank you.
Yeah. Any other doubt till now? I understand that this is not what we intended to discuss, but it is quite important for you to acknowledge this geometric Brownian motion, because this is where your Black-Scholes model starts from.
So we overall consider all the stocks to follow this equation, right?
Yeah, so we basically assume that all the stocks will be, so for a particular stock, we assume that their return will be constant, that is mu, and even their volatility will be constant, that is sigma. Okay, right? So that is what we are assuming. So if you try to see it, let us take it through an example, okay, and then it will be more clear for everyone. So we are having ds is equal to mu s dt and sigma s dw. Okay, so because I work in several different sectors, because I have worked in the futures market, and then now I am working in OTC market, pricing in OTC market. So I might not give you a picture of what mu and true picture of how much mu and sigma is. So let us just take it as an example that for us sigma is 0.06 and mu is, let us say, let us take any value from, so we are just taking numerical example. Okay, so don't kind of assume that it is quite a practical value, and s is the current value of s is 100, right? Let us just assume. Okay, now because and dt, let us say dt we have 1 right now, as of now, just assume, and s is the current price. Dt depends on you. Okay, so how much minute data you have with yourself, right? So because of all this value that we have, we are now in a position to calculate ds, which is the change in a stock price, right? it will be mu, which is 0.03, into S, which is 100, into dt, which is 1, plus sigma S dw. Sigma we have 0.06, S we have 100, and dw, this value will be getting somewhere from, so yeah, root dt and normal distribution of 0 to 1, right? So let us say that the value that we are getting is 0.03. Anyway, so this value will be random, right? Every time we will be getting different value. Every time you will execute it. Let us say, just for the sake of simplicity, we are not going for exact calculation. Let us say we get ds equal to 0.9. Okay. So what will be the next value of a stock price? Because this is a change in a stock price, which is positive. So the next value of S will be 100 plus 0.9, which is 100.9, right? Now everything else will remain same. Your sigma, because this is an assumption of geometric Brownian motion, that the sigma, that is the volatility on the stock, is same, so which is sigma equal to 0.06, mu is 0.03, your S has changed, which is 100.9, and now you can calculate dt after dt will always be 1, it is the initial value. Now you can calculate what will be, so this is your S naught, maybe this is your S1. Now you can calculate S2. So similarly, you can get different values of stock prices in different time instant. For example, at time instant 0, it was 100. After 1 time instant, basically dt time, it is 100.9. Now you can calculate what will be at 2, what will be your stock price, right? So you can calculate it. Just go through the fact that we are assuming the mu and sigma to be constant, right? So this is an important assumption that you must pay attention on, right? Mu and sigma are constant. Okay. While mu is something kind of a return that is not a problematic thing for us, sigma is a problematic thing, because sigma is something that we generally don't observe, right? I will tell you more about sigma in the later in the discussion, because sigma is the point of concern for us, volatility, because the project is on volatility, right? Any doubt till now? Please feel free to ask any question if you have. So this is how so basically this is geometric Brownian motion, and this helps you to figure out a possible path for the stock price. So now you are able to decide what is S0, S1, S2, S3, S4, S100, S1000, right? So basically, what is geometric Brownian motion is nothing but gives you a probable path for the stock prices, right? Given an assumption that the mu and the sigma are constant, right? Okay, so I don't think there is any doubt. So maybe we can proceed. Okay. So now I think we are clear on how to model a stock prices, right? Now let us talk about options. Options are kind of derivatives, as you already know, if you have read the material that I had shared, right? Okay. So that has an underlying. So for example, if you talk about a call option, for an example, and more specifically European option, right? So we are having quite an assumption because we are discussing about European option right now. The European option is something that has a strike price and time to maturity, right? So what does strike price mean? So what is call option? First of all, call option gives you, if you are the holder of the call option, right? If you're about a call option, it gives you the right, but not an obligation, to buy the underlying at a predetermined price, called a strike price, right? At a predetermined date. So basically you will be able to exercise it only at a predetermined date, right? If it is European option. So basically, call option gives you a right to buy, right, but not an obligation to buy an underlying at a predetermined price. So for example, let us say let us take an example, and then it will be clear for you. Let us say there is a stock which is a kind of stock A, right? Its current price is 492. Okay. Now you are of the view that in future its price will increase. Okay. You are of that view that in future the stock price stock A will have an increase in price, and its price will be somewhere around 530 anywhere. Okay. So what you do is that you enter into an agreement with someone to buy this underlying. For example, what is the date today? It is 2nd December. So let us say the agreement says that you can buy this underlying on 3rd March 2025, right? At a price of 500. Let us just say this price is called a strike price, and this time is called time of maturity, right? Maturity time. So basically T. A strike price is denoted by K. Okay. And as per the definition, you can already see that it gives you a right to buy, but not an obligation. Okay. On 3rd of March, if the price in the market, let us say, of a stock A in the market is greater than, let us say, 500. Okay. Then what you will be doing, you can buy that stock A from the guy who has sent who has done the agreement with you, who has done the agreement to sell the underlying to you at this price 500. So you can get it at a lower price because the price in the market is greater than 500, right? You can get it at 500 and sell in the market, right? Otherwise, if the price in the market is lesser than 500, then you are not in an obligation to follow this agreement. You are not in an obligation to buy the underlying from the person, right? From the call option seller, right? So that is what a call option is. Okay, it out till now. That's why your payoff at maturity. So how much money you will be getting at maturity is maximum of s minus k comma 0, right? So basically, the lowest. Basically, if you don't exercise your option, then you will be getting nothing, which is 0. Otherwise, if the price in the market is greater than the price that you will be buying from the option seller, you will be having some profit, right? That profit will be s minus k. S is the price in the market, k is your strike price. So you will be buying from the person at a price k, and then you will be selling in the market at a price s. So that is why your profit in this case is s minus k. Otherwise, if you don't exercise the option, your profit would be 0. So your profit or your payoff at the maturity is maximum of s minus k comma 0, right? And so basically, you can see that payoff cannot be lesser than 0 at maturity. Okay. Now, since your payoff cannot be lesser than 0, right now, if you want to enter into this agreement, you must pay a price to the person, right? Who is selling you this option, right? That price is called option value or option premium. This is the price that you pay to enter into the agreement with that person. Okay. We denote it either by, if it is call option, we may denote it by C, or many times the option premium is denoted by V as well. If it is a put option, then it is denoted by P. So that is not a concern for us. Okay. So the agreement is on the underlying, right? Option is the name of the agreement, and what are we going to buy or sell? The underlying, which is the stock, right? And how is a stock model? The stock is modeled using geometric Brownian motion. So that is the fundamental part of Black-Scholes model. Now let us come to Black-Scholes model. Okay. So to price, now you can see that agreement, the option is an agreement on the underlying, right? That means that to price the option, you need to understand the underlying dynamics of the underlying, right? How does the underlying behave, right? So Black-Scholes model assumed that the underlying behaves according to this equation, which is the geometric Brownian motion. Right? Okay. And then they do a lot of derivation and all the steps, and then they come to the fact, and then they come to the price of the call option, which is P is equal to S naught, which is the initial price of a stock at the time you are entering into the agreement, and D1 minus to the power minus RT and D2, right? Okay. And D1 and D2, obviously, I will be writing the formula for D1 and D2. What is C1? C1 is the price of the call option, right? As I already told that since your payoff, okay, so try to understand it this way, okay. If you are a call option buyer, your payoff at the maturity will be either zero or more than that. That means that to get this money, to get this profit, you must pay someone some amount right now, okay. That price is called the call option value or the call option premium, right? We want to determine what is its true price, okay, and that is the motive. And Black-Scholes exactly tried to do that. They tried to price the true value of the option right now at this moment, okay, given the fact that at maturity you will be getting this much of amount, okay. What is R over here? R is the risk free rate, of course. Any doubt till now? Any doubt? No. Okay, so let us proceed ahead. What is ND1 and ND2? D1 is nothing but ln of S naught by K plus R plus sigma square by 2, then time to maturity divided by sigma root under T. And D2 is D1 minus sigma root T. And N of D1 is just the cumulative normal distribution of D1. So basically, you can just use norm.cdf of D1 to get this value. So basically, cumulative normal distribution of D1. Any issue till now? Okay. So while it is important for you to understand how Black-Scholes came to this price, okay, and I have already, shared the material regarding it. Okay, so maybe after today's lecture, you may again want to go through that, whatever I have shared, so that you get a solid understanding of whatever we are going to discuss. Okay, so the Black-Scholes model assume that of course, first of all, that the sigma is constant, right? The sigma, which is the volatility. Okay, the risk-free rate is also constant according to the Black-Scholes model. Other assumptions are there are no arbitrage opportunity in the market. Okay, what do you mean by arbitrage opportunity? Arbitrage opportunity in the sense that uh, your investment right now is kind of nothing. Okay, nothing in the sense you are not investing anything out of your pocket, and in future you are sure to get certain amount of money or either zero. Okay, that kind of investment is called an arbitrage opportunity. So Black-Scholes model assumed that that kind of opportunity does not exist in the market. Okay, so that are certain kind of assumptions that Black-Scholes model assume. Okay, any doubt till now?
What do we assume as R?
R is the risk-free rate. So basically, generally we assume the rate that is given on treasury bills as the risk-free rate of return. R.
Cool, thanks.
Yeah.
And this sigma is historical volatility.
Yeah, that is an interesting question that we'll be discussing right now after we come across all that out. So basically, this is the point that is that led to the failure of Black-Scholes model, or you can say why we needed some more models. For example, a local volatility model or a stochastic volatility model. So we'll be discussing on it. Yeah. Any other question? So sigma word. The sigma word is quite a mysterious word that is there. Okay. So if everyone is clear with whatever we have discussed till now, other than the word sigma, which of course we are going to discuss right now, we can move ahead. If anyone does not have any question apart from the word sigma. No question?
Actually, one more thing. You mentioned
Yeah,
mu as something like related to returns,
right, right,
right?
right.
So how long the period is that we calculate the returns for?
Okay, so it depends on the calibration. So it depends on, maybe asset to asset. For example, if you want to go for a trading, for example, let us say for a trading period of 1 week, then your mu should be something kind of 1 month, right? Depending upon the period in which you are trying to invest your money, right? So basically, mu should be relevant. That is the point of concern for us. For example, in past 1 year, if nothing has happened, right? So maybe you can take that mu because if you are sure that in coming months nothing of that sort will happen, for example, war or something. So you will be taking that 1 month, 1 year, right? If you are thinking that the market is kind of volatile over right now, then you will be taking that kind of mu which incorporates that volatility period. So that is the generalized version of mu. That is what we do in real world.
Okay.
Yeah. Any other doubt, folks?
Kshitij, I just
Yeah.
wanted to ask,
Yeah, sure.
yeah, for this project's point of view, should we dig deep into the derivation of the call option pair formula from geometric Brownian motion, or is it fine if we just remember the formula and apply it in our project?
Maybe I will suggest that you derive it once. Okay, it is it is quite interesting and gives you a lot of confidence. So the first time I derived it, I was quite happy, and it helps you understand where it is coming from. Okay, so you take all the assumptions, you see where this assumption is actually helping us. Okay, so it will be helpful for you, and the book for it is Paul Wilmot. So it is derived quite nicely in that book. So I would suggest you once go through the derivation part
Okay,
if you
okay.
have time.
Paul Wilmot, Introduction to Quant Finance, right? Is that
Yeah.
the book that
So
you're
in that
trying
book,
to
it is
recommend?
derived
Okay,
quite nicely and in an intuitive manner. Maybe you would like to
perfect.
refer to that book once.
Yes, thank you.
Any other question for people?
Can you just repeat what exactly the DT was? Like in your last example, your DT was like 1. So I mean, what
Okay.
exactly the DT is?
Yeah. So in that example, ignore that part because I was taking unrealistic value over there. In the real world, DT is the time period. Basically, it depends on you. Okay. So for example, in a period of 1 year, let us say, so let us take for example a period of 8 hours, right? If you have a total period of 8 hours, okay. You want to find what will be the stock price after every 1 minute. Okay, so in that case, what will your dt? It will be 1 minute divided by 8 hours. Okay, so you will be doing right. Did you understand?
Yes, 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 I got it. Thank you.
Dt is that kind of time difference. Okay,
Okay, okay.
so yeah, one one suggestion to all the folks out there is please be consistent with the units. Okay, it is quite important because I have been using this frequently, and every time I am quite, I have seen people, making mistakes. Okay, so let us see how you should be consistent with the unit. Okay, so
DT is to be
ds is equal to mu. Yeah, please,
DT is supposed to
please.
be from the data itself, right? The frequency of the data and the chunks we are looking at, like the time chunks we are looking at, right?
So yeah, so your data might be spread in a long term, but you may want to observe the stock prices in a, so it depends on you, like how you want your DT to be. So at what time intervals you want your data to, you
Ye-
want to observe the data, right?
Yes, yes. Like for example, if the horizon is let's say 1 year, so we can look at multiple time frames, right? Like 5 minutes, 7 minutes, or 10 minutes, based on.
Exactly, exactly, exactly.
So in that case,
So
the DT will be those time frames for different analysis, right?
right, right, right. And
Yes.
I'm yeah, so you're right. And I was just telling that please be consistent with unit. Okay, so DS is the change in stock prices. Okay, so it will be in maybe say currency, right? Your currency, your unit. Okay, so this thing should also be in that unit. Okay, that means that your mu dt should be unitless. Okay, that means if your mu is kind of per year, right? If your mu is kind of per annum, that means per year, percentage per annum. Okay, that means your dt should be in year. Okay, so please keep this in mind. So many times I've seen people making mistakes over here. So this mu and dt should be coherent with the unit. Okay. Got it?
If you can give an example, that would be better, like in this.
Okay. So what I'm saying is, if you are calculating the return, right, per year, right, you are saying that I am getting 12% return on my stock per year, right? So the unit of this mu is 12% per year, right? So the year is in denominator. In that case, your now, yeah, before that, your DS, right? DS is in currency. So for example, it may be in INR, right, or dollars, anything like that. That means that this term and this term should also be in that currency, INR, right? Because as you already know, if this thing is in a particular unit, then this thing should be in a particular unit, this thing also should be in that unit. If it is in meter, this should also be in meter, this should also be in meter, right? Is it clear?
Yes, yes,
So
yes.
this term should also be in INR, that currency. S is already in that currency, okay? S as is unit of that currency, right? So that means mu and dt should be unitless. Otherwise, it would. So for example, if mu dt is not unitless, for example, the mu dt is kind of uh, giving a unit of year, then this would become INR year. This will be that unit, right? That's why the mu dt should be a constant rather than something having a unit. Now, if mu dt is constant, that means that if you are expressing mu as a per annum thing, then your dt should be in year. Okay. So for example, if it is dt, if your time frame is 1 day, then it should be 1 day divided by 365 year, right? So if, then it would be converted into year. So please take care of this mu part, right? Okay. So is there any other question? If not, we'll come on to sigma part. No? Okay. Okay then. So let's come to sigma. Okay. Sigma is nothing but volatility, right? And there are various versions of volatility. Historical volatility, then your actual volatility right now, then your realized volatility, and then your implied volatility. Okay. Okay. So the question with so if you are talking about the Black-Scholes model, right? The mu term does not appear in the Black-Scholes model anywhere. Okay. So you can see this mu does not appear either in C part or here in the D1 part as well. So maybe I would share this question as a task to you. Try to find out why doesn't the expected return that we are getting on a stock affect the call price of the call option. So as you can see, mu does not appear anywhere, but sigma appears, right? So this mu does not appear. I guess many of you might already be knowing the answer, but try to find out. It is quite an interesting, question, and the answer of it you would be knowing if you have derived the Black-Scholes model by yourself. And yeah, so this makes another reason for you to derive the Black-Scholes formula, and that will help you understand why does not the mu appear in this equation, both the theoretical region and the mathematical region as well. Okay. So since mu does not appear in the call option formula or the price of the option, we are not concerned about it, but we are pretty much concerned about the sigma, because if you do not enter a correct sigma, right, then you won't be getting a correct option price. Okay. Now that is the problem. What kind of volatility should we put into the equation? Okay. Whether it is historical volatility, actual volatility. What is historical volatility? Volatility that is observed over a period of time. Okay. In history of that stock. Actual volatility is the volatility right now on that stock. Realized volatility is kind of try to understand if you are pricing this option here, okay, pricing the option at this time instant, okay, and at this time instant, right, and you are saying what will be, and you are saying that okay, sigma will be something, and this is the at this time frame we are looking into the volatility, okay. So you entered something, let us say you entered sigma equal to 15% volatility, but now at this time instant, okay, or right now, if this is a maturity period, okay, if you are looking into the maturity period and then you look back and say okay, I had entered a value of sigma equal to 15%, now let us see, let us track the path of the stock prices and see what at this instant you will be seeing what is was the volatility, okay. That volatility is called the realized volatility, okay. So what was the volatility during the option path, okay, on the underlying, right? So what was the volatility of the underlying during this time frame, okay? That volatility is the realized volatility, okay. What do we enter into the question is what volatility should we enter into the sigma, what which is the correct among these four? The correct volatility is the actual volatility right now which is existing in that underlying, okay. That is the actual volatility that we should enter. But the complexity is we can't measure the volatility. You can't say okay, this is the underlying, this will have this unit, this much volatility. This is quite, it is something similar to saying okay, at 7 p.m 13 minutes 1 second, this underlying was a volatility of 18% or 20% right now, 29% right now. It is not, it is difficult to measure actual volatility right now. If you have a time frame, it is, you can say at this time frame the volatility was this much, right? But at a certain instant, so historical volatility refers to a time frame, okay, but actual volatility refers to a point in time. It is not a time frame, it is a point, and it is quite difficult to tell the volatility at a point, and that is the problem with the Black-Scholes formula, okay. Got it? Any doubt till now?
Can you
Hello.
please discuss the difference?
Yeah,
Hello.
please. Yeah.
Can you please repeat the previous point again? I just missed that. I wasn't
Okay.
able to hear your voice properly. Yeah.
Okay. So what the point that I'm trying to make is the correct input of the Black-Scholes formula, because sigma is an input, right? Because it appears in D1 and D2 as well. Okay, and that gives you the price of the call option. So what volatility should we put? We should put actual volatility, which is the volatility right now in the underlying. If you want to price the option right now, okay. That means now the problem with the actual volatility is that uh, it is a volatility at a certain time instant, okay. It is not a volatility in the time frame that you can measure. For example, if you are talking about historical volatility, then you can say okay, in this period the volatility is this percent, right? In this period the volatility was this percent, okay. If it is realized volatility, then also you can say. But talking about actual volatility is about a time instant, okay. So at a particular time what was the volatility, and it is quite difficult to say. At a time frame, if there is a time frame in which you have to measure the volatility, it is quite easy. Let the time frame pass and then you can say what was the volatility in that time frame. But at a certain instant, let us say what is the volatility at 7 p.m 7:33 15 second. What will be the volatility at this instant? You can't say, right? But this is the input to the Black-Scholes model, actual volatility. Are you getting the point now?
Yes, yes, I got it. Thank you so much.
Okay. So uh, that boils down to the problem that we are having, okay. So basically let us see, we are trying to price an option. To price that option, the inputs that we need is let us start from beginning. We need S naught, which is the current stock price, okay, we can provide the current stock price. We need K, okay, we can provide K. We need R, you can provide R as well, okay. D1 and D2 are two inputs, and D1 and D2 are just the expression of other terms. So what are other missing terms? Sigma and T, okay, other than everything that we have mentioned, right? T we can provide, okay. Sigma is the term that is problematic for us because we're not sure whether what value of sigma should we provide to the Black-Scholes model, right? Okay, so let that sigma be over here. Let it be here. So what I would be saying, I am sitting idle and saying that if I had volatility, then I would be getting the price of the call option. Okay. So this is the only thing that I need. But someone from the market is saying, okay, I have the price of the call option right now. What is the price of the call option? That I can tell you from the market. Okay. Let that price be V. Okay? So the Black-Scholes formula gives you the price of the call option given all these inputs. That is S naught, K, R, T, and sigma. It gives you the price of the call option, which is V. But I'm getting V from the market. I have put V over here. Now what I do, I reverse the problem. So instead of finding the call prices using these 5 inputs, I try to find out what sigma should be put into the Black-Scholes formula to get this V, to get this call option price. Okay. Notice that this is price I'm getting from the market. The sigma that I would be getting is called the implied volatility. Any doubt till now? What is implied volatility?
Kshitij,
Yeah,
can you tell
please.
me the difference between realized volatility and historical volatility?
Sure. Okay. So historical volatility is, okay, try to see it like this. You are over here, okay, and you are trying to measure the volatility over this period of time. Okay. That is your historical volatility. You are putting that right here. Okay. Realized volatility is you made a prediction over at this point, okay, saying that in the future this underlying will have a volatility of certain percent. You made this prediction about the future, and now you are observing what was the volatility right now, what was the volatility at this instant, what was the volatility at this instant, what was the volatility at this instant. So intuitively it might seem kind of they both are same. Basically historical volatility and realized volatility are same, but try to understand it like this. It depends upon uh, the actions that you took. So historical volatility is the sense, uh, at this point I would be taking the historical data and be putting into the Black-Scholes equation. Realized volatility is something like, so realized volatility cannot be put into the Black-Scholes equation, of course. So you are making a prediction about the future, that the future will be having a volatility of this much percent, and then you are observing that period, and you are saying that okay, this had a realized volatility of this percent, okay, this had a realized volatility of this percent in this time frame. So that is the concept of realized volatility. Okay.
Sure, sure. Got it, got it. Yeah.
Yeah.
And
So when we
still we
talk about,
measure
yeah,
using and
sure.
still we measure that using historical data only, right? Even
Yes.
that realized data, realized volatility. So,
Could you please ask your question again?
we were explaining that realized volatility is the one that we measure after we compare with our implied volatility, something like that.
Right, right, right,
Still,
right.
if we are predicting at T1 some implied volatility, T1 to T2. When you
Okay.
are at T2, you measure realized volatility between T1 to T2. Then still we will be using historical data to calculate that realized volatility.
Right, right. So we will be using historical data only to, basically to get that volatility. So it's kind of, you can say that they both are kind of similar thing, but realized volatility is kind of, we are just naming it realized volatility because we want to see what we were assuming about the volatility and what really happened. That kind of thing. Otherwise, it does not have any practical significance in the options world. Okay.
Okay, thank you.
Yeah. So now when we talk about the term implied volatility, so the problem with us was we were not sure what kind of volatility should we input into the Black-Scholes model. So that is why we left it out. Okay. So Black-Scholes model was something, given the 5 input, it would give you the call option price. I am saying that I have the 4 input and I have the output as well, which is the call option price. What sigma value will correspond to this call option price? Okay. That value of sigma is called implied volatility. Is that clear right now? Is that clear? The mathematical meaning of implied volatility?
So what you're
Yes,
basically
yes.
trying to say Like if we have given the price of a certain option value, that is the premium from the market, and if
Right.
we all the other parameters, like assume parameters of the Black-Scholes model, the the value of volatility from that formula that we derived is the implied volatility, right?
Right, right, right. That is the inverse way. So basically, Black-Scholes model was a model to convert these 5 inputs into an output. Okay, right? But we don't have an input. So what we are doing is that we are trying to find out which which sigma would correspond to this call option price. Okay, we'll be trying different sigma. For example, sigma 1%, and then we'll check whether it is matching the option price. We will be trying another sigma, then we'll be checking whether it is matching the current option price. That sigma which matches the current option price will be okay. This is the sigma that that should be the input to the Black-Scholes model. That sigma is called implied volatility. Okay. Interestingly, there are two methods that you can. So Black-Scholes model is a PD, right? Partial differential equation. So this is also a good project for you guys to work on. So Black-Scholes partial differential equation is there, right? That has, if you solve that partial differential equation, you get the price of call option, which is V. Otherwise, you can what you can do, you can reverse there out, and you can use this method called Newton-Raphson method, or bisection method, to get that implied volatility from that partial differential equation from the Black-Scholes formula. Okay, Black-Scholes PD. So that is not a point of concern for us right now, because I just wanted to uh, but I just wanted to help basically communicate that you can calculate the implied volatility from the Black-Scholes equation, so, by using these two methods, either Newton-Raphson method or bisection method. Okay, so so far so good. Okay, now intuitively, what does this implied volatility mean? Let us try to understand that. Okay, what is V? V is the price of call option. Okay, now if V is the price of the call option, right? Now, and if you're selling with the call option, right? So let us try to see it over here. Let us say I am the seller of this call option and you are the buyer of this call option. Okay, and I am saying that you can buy, you have the right but not an obligation to buy this underlying from me at a price of 500 on 3rd March 2025. Okay, that means that I as a person have a view about the future, that in future the underlying will not go above 500. Okay, and you will not be exercising the option, and I will get the premium, I will keep the premium with myself. So this call option price, the premium, is a view about the future, right? And since it is a view about the future, you can say that this implied volatility is a view about the future volatility. Okay, that means in the options lifetime, what will be the volatility observed in the underlying in the coming time? So if you are calculating the implied volatility right now, this is the time to maturity. Then basically by implied volatility, what we mean is that what is the average volatility that will be observing in the underlying in this time period. Okay, from current time to till the time to maturity of the option. What volatility will we be observing in the underlying in this time period? That is the implied volatility for you. Any doubt in now?
Can we say that this implied volatility is um, the expected amount of volatility which the market participants are expecting?
Yeah, in the same way, right? So basically, if what are call prices? Call prices are the expectations of the market, right? Basically, I and you are agreeing on this price. Otherwise, the price would be different, right? Try to understand it this way. Okay, so let us say a certain stock has a price of 100. Why is the price of that stock 100? Try to understand in this way. If I as a person believe that the price of this stock should be 102, I will be buying this stock, right? And I will be buying that stock until its price goes to 102, because I believe that its price should be 102, and if it comes to that price, I will be selling it. So whatever is the market price of any instrument out there, whether it is options, whether it is futures, whether it is commodity, anything out there, it is the market, because people believe that it is the true price. that means that this V is the view of the people in the market, and that means that sigma is the view of the people about the volatility in the future. Okay, so that is, yeah, so you are very much right. Sigma is kind of the volatility that we are expecting in this underlying in the time, in this time frame, that this instrument will have a volatility of this much percent, right? Any doubt? Any doubt so far? No? Okay, so if you don't have any doubt, then let us try to frame the problem statement, basically a part of problem statement. Okay, and then we will wrap up the today's session. Okay, so maybe you should try to, you should also try to do it. Go to Nifty's option chain. Okay, search Nifty option chain on Google and enter into the first search that comes up. Okay, Nifty option chain. Maybe I should try to show it to you people. Just a minute. Okay, so here on my screen is the Nifty option chain. Okay, as you can see, and so uh, you can see these are all the options on Nifty. So underlying over here is Nifty, right? So kind of understand it, kind of DS is equal to mu SDT plus sigma SDW. That S over here is the price of Nifty. Okay, which is as of now, which is Nifty is kind of 24,276.05 right now. Okay, so this is the underlying. Okay, so this is S right now, S current S. Okay, these are all these options on X, which are going to expire on 5 December 2024. Okay, this is an option having a strike price of 21,600. Another option below that having a strike price of 21,650. An option. So these are all the options having different strikes. Okay. Uh, Please keep in mind that all these are options. Okay, each row corresponds to one option. All these options are going to expire on 5 December 2024. Okay. Now try what I'm trying to say. All these are different options as well. Okay, but on the same underline. Okay. Now try to understand what I'm trying to say. This column is for IV, which is implied volatility. Try to see that each of the columns are having different implied volatility. Okay. These are different options and are having different implied volatility, but the underlying is same. Okay. Now let us see what I'm trying to say. Okay. First of all, an underlying can have multiple options, right? For example, if the underlying is Microsoft, it can have multiple options on it, each having different combination of a strike price and time to maturity. Okay, sorry, KT. So an underlying can have multiple options on it, and these are the example. Okay, So all these options are having the time to maturity. 5 December. It did not come in the screenshot. And on for options, those options which are having time to maturity of, you can say 5 December. These are different options having different strike. First option is having a strike of 22,600, 22,650, 22,700, 22,750, 22,800, right? And each of these options are having different implied volatility. Okay, all these are options on same underlying. They are different options because they are having different strike, but they are having the same time to maturity. You can change time to maturity as well. So all these are options having expiry date as 5 December, which is the maturity time. You can change it from here. Now all these options are having expiry date as 12 December, right? 25 December. So these all are things are there, right? So let us not worry about it. But you can see that an underlying can have multiple options, and each options will have different strike price and time to maturity. Okay. Now you can see that all these options are having different implied volatility. 40.74, 28.38, 30.46. But don't we think, why are these options having different implied volatility when they are on same underlying, right? Basically, if you talk about underlying, if you talk about Black-Scholes model in general, where does sigma come into? Sigma comes from this equation, mu SDT plus sigma SDW, right? This sigma volatility is nowhere related to uh, you know option, right? Sigma is in general a behavior of stock underlying, right? So why these options which are on the same underlying are having different implied volatility? Okay, are you able to understand it? So Black-Scholes model says that all the options on a particular underlying, okay, all the options on a particular underlying. What does Black-Scholes model say? And so basically, people use this term. What does Black-Scholes model say? All options on same underlying, irrespective of K and T, right, will have same volatility, right? I do not, I do not like to call, quote this term like this, because Black-Scholes model do not say it. It is, it is how Black-Scholes model behaves, right? Because this sigma nowhere appears. So sigma is not a property of the option. Sigma is the property of the underlying. So no matter what you construct on that underlying, right? That option. So basically, options are made from underlying, right? Options are made on underlying, and underlying is having mu and sigma. Now an option will be having certain K and T, another option will be having certain K and T, another option will be having certain K and T. Because of that, implied volatility should not change. Implied volatility on the underlying will be same, right? Because it is sigma. So basically you are saying that, so try to understand it like this, okay? So, so what we are saying is, if you are taking this option, right? If you are taking this option, if let us say you had this option on the underlying, okay? Only this option on the underlying. You reverse everything and you found out implied volatility as 40.74. You came to me, okay, and you said, you are saying that underlying has a volatility of 40.74. Someone was observing this option on that underlying, and from there he calculated the implied volatility, which was 28.38, and now he's saying that no, underlying will have a volatility of 30.46 during options period lifetime. Is it possible? No. Isn't it a contradiction, right? That is the problem. Implied volatility for all the options should be same because they are on the same underlying. Why should the volatility change with K and T, right? Because volatility nowhere comes as a property of the option. Volatility was the property of the underlying. Is it clear, everyone? This is the most crucial point right now.
So, uh, so if like what you're trying to say, that given that there is the underlying and there is the current price of the underlying, right? So at
Right.
different stages, that is the strikes, right? we have different levels of volatility or variation or expected variation. Like if supposedly the underlying reaches the level of say 23,350, then the variation would be of 28%. If it is at a certain strike level, then it would be of around
No,
40%.
not like that. Not like that. See, strikes and time to maturity, these two terms are nowhere related to underlying, right? All these two things are property of option. Okay. So, for example, on the underlying of micro, this is underlying over here is Nifty, right? On Nifty, we can make several options. All these options are having time of maturity as 5 December 2024, and these are having different strike. All these are different options. Okay. This is the strike price, which is 22,600. Okay, of an option. So this option, the first option is having a strike price of 22,600 and time to maturity of 5 December. Okay. Now, according, so, and IB is not mentioned over here because I think it should be giving negative IB according to me, right? Over here, it is 22,900, this is strike, and it is having a implied volatility of 40.74. So according to this option, this underlying will have a volatility of 40.74 during the period. According to this option, this is a different option. The underlying will have a volatility of 28.38 in the period. Underlying will have a volatility. So try to understand it this. All underlying will have a different volatility according to the options on the same underlying, right? Is this possible? So basically, what we were expecting is that all the options on the same underlying will have same implied volatility. That should give us same sigma, right? Because they all are the option on the same underlying. Because sigma is something that appears on the underlying. Sigma is something that is the property of the underlying, right? Or okay, try to understand it like this. Okay, this is an interesting example that I guess you should be able to do understand. Okay, so let us say you have two options on Nifty. Okay, let us say you have two options on Nifty. First one is having a strike price of 22,900, 22,900. Okay, and second one is having a strike price of 28.38%. Sorry, a strike price of 23,200. Right? This is having time to maturity, which is 5 December. So it is 3 days from right, 3 days from now. So let us say 3 days. These are two options. Okay. Now, if you reversed everything for this option, this will give you an implied volatility of 40.74%. This option will give you an implied volatility of 28.38%. Sigma to 28.38%. Okay. Okay. Now, let us say for a group of people, let us say we made this A group people, B group people. What is the current value of S naught for Nifty? Let us see. S naught is 24,276.05. 24,276. Okay. Right. Now forget the option part. I am erasing the option part. Okay. Mu. Let us say I am giving mu to both the side from the historical data. Maybe say let us say 10% to both people. Now try to do that geometric Brownian motion task. S is equal to mu s dt plus sigma s dw. Right? Take dt equal to 1 day. Now, don't you think both this group of people will be saying that the underlying will follow different? No, don't you think that and both these group people will be saying that underlying will be following different path, right? Don't you think so? This group of
Yes,
people will
yes,
be saying
absolutely.
underlying is following a path which is correspond to sigma equal to this and sigma equal to this. Is it possible?
Yes.
Underlying should
Yes.
follow the same path, right? Got it? This is the problem of the Black-Scholes model. Basically, we assume that sigma was constant. Now, because of that part, options which are having different strike price and time to maturity, so different options on same underlying should also have same sigma, right? Should also correspond to same sigma. So if you, because these are options on same underlying, right? The sigma is the property of the underlying. It is not the property of the option, right? So this is where problem is coming, and we will discuss it in our next lecture on how to solve this problem, or basically more on this problem. If you have not understand what the problem is, please let me know. Otherwise, we will discuss
In that
more.
case, why don't we use the historical volatility? Like, what's the issue with that?
Okay, the issue with the historical volatility is in the way over which Black-Scholes model is formed, right? If you want to
Hmm?
calculate the price of the option right now, you should be so the input that it expects is the volatility right now, which is the actual volatility. Okay, volatility at a certain instant, right?
Okay.
So you can't put historical volatility as an input, because what you want is the current option price. So what you will be entering is the current volatility, right? Or even the
Hmm.
volatility that you think should be realized in the options future. So it is interesting. It is interesting. So basically, if you see this problem like this, okay. So let us take this problem. 494. 492 was the current price of that underlying, and 500 was the strike price. So if I want to price this option, what I will be doing is I will be considering about the volatility in the future, right? What volatility will we be expecting in the underlying in the future? Whether in the underlying the volatility will be so high that it will cross 500. Then in that case, I would not be selling this option at a lesser premium, because if the volatility expected volatility in the future is high, then there is a good chance that it will cross 500, and in that case, I would lose money. So in a sense that in the Black-Scholes model, the input that is expected is the actual volatility in the way it is made, or otherwise a kind of in a sense, a mixture of the volatility that we are expecting in the future, not the historical volatility. So basically, in our day-to-day tasks, we are used to use mu and sigma as the historical data. Mu is not a problem for us right now, because we don't want to model how a stock price looks like in the future. So that is why I took mu equal to 10% here from the historical data, but mu does not appear in the Black-Scholes formula. So we are not concerned about that part, whether you should put mu historical or anything like that. So that is why it is not a concern for us. The concern for us is volatility, which is an input to the Black-Scholes model.
So basically, you are trying to say that, am I audible?
Yeah, I'm audible.
Yeah.
You are audible.
So basically, you are trying to say that if the IV is different for like all the options, then what is the real IV that we should take account in BSM model, right?
Right. That is the thing that we discussed while we were introducing the concept of volatility, right? So what volatility should we put as an input to the Black-Scholes model, and that is where implied volatility came from, right? Am I audible?
Yes, but like we can see that the implied volatility is different for each strike, right?
Yeah. Okay.
Then what is the ideal implied volatility we should take to put in BSM model?
That is what we'll be discussing later on, because
Okay.
this is the problem, right? We are assuming that sigma is a constant, but we are getting different sigma when we are taking different options on the same underlying. That means that somewhere we are doing wrong. Okay, either the
Okay. Okay.
Black-Scholes
Yeah.
formula is wrong, or the way in which we are modeling the stock price is wrong. Okay, so maybe the way in which we are modeling the stock price can be wrong, because sigma cannot be constant. So that may be a problem for us, right? So we'll be trying to see where is the problem exactly.
Okay. Got it.
Yeah. Any other question, folks? No? So maybe we can wrap up the today's session. You all were an interesting participant. Let me know if you have any feedback for me in the group. I'll be sharing some materials for you to read. And I hope we had an engaging discussion today and you got something to learn and not wasting your time. Right? Okay, thank you everyone.
Thank you,
Thank you.
Kshitij.
Yeah.
Thank you.
Thank you, Kshitij.
Thank you.